Hello, everybody. Welcome to my problem 14.5 Intermediate Accounting 17th edition video solution walkthrough. This textbook is from Intermediate Accounting 17th edition. Authors are Don Kiso, Jerry Weinganten, Terry Warfield. The question used in the presentation is copyright 2019 by John Wiley and Sons. All rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. The solution presentation is copyright 2019 to 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennett Tchaikovsky and not the authors of the textbook or of Wiley. Okay, let's have some accounting fun. So here we've got problem 14-5. In each of the following independent cases, the company closes its books on December 31st. So Sanford sells $500,000 of its 10% bonds on March 1st, 2020. The bonds pay interest on September 1st and March 1st. So it's semi-annual. The due date on the bonds is September 1st, 2023. The bonds yield 12%, give entries through December 31st, 2021. Okay, well, we're just going to go ahead and do everything. So the first question is that was this bond issued at a discount or at a premium? Well, over here, the bond was issued at a discount. And how do we know that? The stated rate of 10% is less than the market rate of 12%. Okay. So right over here, so that means the bond will be discounted to effectively yield the market rate. Okay, so I'm going to have to discount my bonds or sell it for less than the face value in order to be able to sell it. So when I have this situation, which is over here on March 1st, 2020, I'm going to have a discount on bonds payable. I'm going to be debiting cash, and I'm going to be crediting bond payable. The bond payable, it always is done at the face amount. So the face amount of this bond is $500,000, which is for Sanford. They usually really use Sanford and Sons, so Sanford Company. So Sanford Company. So this is to record bond issuance. Now, this is all fine and dandy, but what we need to go through and do is we need to figure out how do we determine the amount of cash. So right over here, so a bond works as though it's an interest-only loan. So I'm going to have over here the face value of the bond that'll pay at the end of the due date of the bonds is September 1st, 2023. So basically over here, I'm going to have a face value of 500,000. And then over here, I'm going to have my interest payments. So my interest payment is going to be 500,000 times 10% times half of that amount. Okay, so why is it half of that amount? Because whenever I see okay, so now what I want to do on this one is I think I want to actually write out all the dates. So I sell them on March 1st, and they're going to pay interest. So on 9/1/20, my next date is going to be 3/1/21. My next day is going to be 9/1/21. And then I've got 3/1/22. Then I'm going to have 9/1/22, 3/1/23, and then 9/1/23. So those are going to be the dates. So the due date of the bonds is September 1st, 2023. So we've got 1, 2, 3, 4, 5, 6, 7. We have a total of 7 payments. So when we go to the tables, okay, what I'm going to be going is I'm going to do for the face value, I'm going to use present value of $1. it's going to be 7 periods at 6%. Now, why are you saying it? Why is it at 6%? The 6% is the semi-annual rate or semi-annual market rate of interest. Okay, so 6% is the semi-annual market rate of interest. And for this over here, because it's basically 12%, is the annual rate divided by 2. Okay, so this is going to be 7 periods at 6%. For the interest payment, this is going to be the present value of an ordinary annuity of $1. And this is also going to be 7 periods at 6%. So present value of an ordinary annuity of $1, 7 periods at 6%. Is going to be 5.58238. And then for the present value of $1, 7 periods at 6% is going to be 0.66506. So my present value of these future cash flows so the present value of the principal, present value of the interest. So over here, the principal was $332,530. Of the interest payments, it's $139,560, and this is $472,90. So I know I've done this correctly because my cash proceeds are less than my face value. So my discount on bonds payable right over here is going to be $27,911. Okay, so give entries through December 31st, 2021. So what I'm going to go ahead and do now for the 2 cases, and then we're using effective interest for the discount or premium amortization. Let's just go ahead and let's go ahead and do the tables. So the bond was issued on March 1st. Basically paying interest for the first time on September 1st, 2020. So my bond carrying value is going to be the face value of the bond. So I'm going to have bonds payable, and I'm going to have discount on bonds payable. So my bonds payable amount is going to be $500,000. My discount on bonds payable is going to be $27,911. So my carrying value over here is going to be $472,090. My interest rate is at 6%. Okay, so I use the half the market rate. The market rate was 12%, but I'm paying interest semi-annually or every twice per year. So over here, my interest expense is going to be $472.90 times 6%. Okay, my interest payment is going to be how much? Well, it's going to be the $500,000, which is the face amount of the bond, times 10%, which is the stated rate of interest, times half of that because it's being paid every 6 months. So this over here, my interest payment is going to be $25,000. So the difference between over here, the difference between the interest expense and the interest payment is going to be $3,325, which is going to be my discount amortization. Okay, so when I take A, I'm going to add this to my discount amortization. Remember, what I'm trying to do is if I'm doing this as a journal entry. Okay, so when I pay, if I'm in a discount situation and I have interest expense, what does my entry look like? I know I'm always going to be debiting interest expense, and then I'm going to be crediting cash. Okay, essentially over here for the Cash is always going to be credited for 25 grand, but I need to make this discount go down to 0. So I'm going to credit the discount on bonds payable, which in this case over here would be the amount of my discount amortization. And so this would give me my total amount of my interest expense. So this is how we record a journal entry for this particular situation. So this ending becomes my beginning. The amount of my interest payment will never change. And what I want to see is this, is that did we get back up to the face amount of the bond? And we did by September 1st, 2023. So we know we've done this correctly. Okay, so from a tile of sales, the date indicated. Okay, so right over here. So the next part is going to be give entries through December 31st, 2021. Okay, so the entries I would typically be going through and making is that I would be going through, so my first entry over here on 9/1/20 is going to be this right over here. Now, where this gets interesting is that that's interest expense through 9/1/20. But when I get over here to 12/31/20, I've got a problem, okay? And my problem is that, well, it has a 12/31 year end. So what do I need to do, right? So right over here, what I'm going to do is I'm going to go ahead and record. I'm going to debit interest expense. And the way I'm going to do this is I'm going to take the amount of the interest expense on March 1st, 2021, or of the following period, and I'm going to multiply that by 4/6. So I'm going to take, what is it? This is going to be 28,525, which is interest expense at 3/1/21. I'm going to multiply that amount by 4/6. So right over here, I'm going to debit interest expense. I'm going to credit discount on bonds payable. I'm going to multiply this over here also by 4/6. And then I'm going to be crediting interest payable. Okay. So, right, why am I going through and doing this? Because we're paying interest at irregular intervals. So what I have to do is I have to make the accrual. And if you notice this, should this work, if I take 25,000 times 4/6, why am I using 4/6? Because it's September, October, November, December, 4 months. And then I've got the January, February in the next year. Okay. So what I would do here is that you can do one of two things. You could go 3/1/21, and obviously I'm missing out the entries here. What we could do here is on 3/21, we can debit interest payable. I can debit interest payable. I debit interest expense. I'm going to credit my discount on bonds payable. And then I can also, I'm going to credit cash. So I'm going to credit cash over here for 25,000. The amount of my discount, my amortization of my bond discount is going to be 3,525 times 2/6, or 1,175. So the amount of my interest expense is going to be 9,508. Now, to make sure that I've done this correctly, what can I do? Well, if I add up 9,508 and 19,017, I get 28,525. And then if I add up 1175 plus 2350, I get 3525. So that's the way I could do it. The other way I could do this entry is I could also, too, as an alternative, I could reverse out. I could debit interest payable. I could debit discount on bonds payable, and then I credit interest expense. So what I can do if I want to is reverse this accrual over here. And then for my normal journal entry, what I would then just do is on 3/1/21, then I would just record the interest expense of 28,525. My discount on bonds payable is 3525, and then I'm crediting cash for 25,000. So my alternative, use a reversing entry. Okay, so that's one alternative to going through and doing this particular question. So I could do this either way. You're going to get to the same results. Okay. Usually a lot of times we can use reversing entries if we are going through and doing these types of things. Okay, so it's asking us to do the journal entries through 12/31, 12/31/21. So we're not quite done yet. So what would happen next? Okay, so for over here, my next interest date is going to be 9/1/21. I'm going to debit interest expense for 28,736. My cash payout is always going to be 25,000. Then I'm going to be crediting my discount for 3,736. Okay, so for my next part over here on 12/31/21, right, what do I go through and do? Well, my interest expense is going to be my 3/1/22 amount times 4/6, or September, October, November, December. I'm going to have interest payable, and I'm also going to have a discount on bonds payable. So my discount on bonds payable right over here is going to be $39.61 times 4/6. Wait, hold on. This is V20. Yep, okay. So right over here, this is 28,961. My interest expense on 3/1/22 times 4/6. This over here, my discount on bonds payable is going to be 39.61, which is discount on 3/1/22 times 4/6. And then my difference would go over here to interest payable, which is, ironically, it's always going to be the same amount because it's the accrual based on the cash. Okay, so I missed out. I didn't put in the journal entry descriptions. We know what we'd have to go through and do there. So until the date indicated. So March, bonds pay interest on September 1st and March 1st. The due date of the bonds is September 1st, 2023. Bonds yield 12%. So we've gone through and done that first particular part of problem 14-5. Okay, so let's now go through and take a look at number 2. So we've got this company sells 400,000 of 12% bonds on June 1st, 2020. The bonds paid interest on December 1st and June 1st. The due date of the bonds is June 1st, 2024. Before I go any further, I'm just going to check my solution. Okay, I did that part correct. Hopefully I can do this one too. Okay, so Titania, wow, sells 400,000 of 12% bonds on June 1st, 2020. The bonds pay interest on December 1st and June 1st. The due date of the bonds is June 1st, 2024. The bonds yield 10%. On October 1st, we buy back half of the, or 120,000 worth of bonds for 126 and includes accrued interest. Give the entries through December 1st, 2022. Wow, this is going to be fun. Okay, so let's go through and figure out the payments we're going to be making for this bond. Okay, so we sell on 6/1/20. The bonds yield 10%. So the stated rate is higher than the market rate. So therefore, for this particular one, and let's go ahead and do this. Okay, so I sell the bonds on June 1st, 2020. The bond's stated rate is a higher rate than the market rate of interest. So the stated rate of 12% is greater than, the stated annual rate of 12% is greater than the market rate, 10%. Bonds will be sold at a premium. Okay, so when I go through and record this, I'm going to go ahead and debit on 6/1/20. I'm going to debit cash. I'm going to credit bonds payable. I always credit bonds payable for the face value. So I'm going to credit bonds payable over here for 400,000. And I'm going to have a premium on bonds payable, which we don't know what that answer is yet, is to record on issuance. Okay. So the first date of this is going to be 12/1/20. The next date would be 6/1/21. The next date would be 12/1/21, 6/1/22, 12/1/22, and then we've got over here 6/1/23, 12/1/23, and then they're going to be ultimately be redeemed on 6/1/24. Okay, so we've got 1, 2, 3, 4, 5, 6, 7, and 8. So we've got a total of 8 payments. Again, I really recommend to you, when you have questions like this, is like do the documentation and write it out, especially if you have Excel, and you'll have Excel for your exams, or at least for your CPA exam, maybe not my exam, but you will have it for the CPA exam. Okay, so the thing we want to go through and do here is we've got, okay, so let's now figure out our payments. Okay, so what is this bond going to be paying out? Well, the first part of this is it's like an interest only loan. So my bond payable face value is going to be at 400,000. Okay, so that's my bond payable face. My interest payment, my cash paid for interest is going to be 400,000 times 12%. But since this bond is paying interest semi-annually, it's going to be done by half. Okay, so bond payable face value, 400,000. My interest payment is 24, which is 400,000 times 12%, but that's an annual rate times 6/12, semi-annual. Okay, when I go to my tables, right, what I'm going to be doing on the tables is right over here. is that I'm going to go to, for the face value, this is going to be present value of $1. This is going to be 8 periods at 5%. Why is it 5%? 10% annual market rate divided by 2 is 5% semi-annual market rate. Okay, so this is also going to be over here. This is going to be present value of an ordinary annuity of $1. So let's go ahead and look these up. So this is going to be 5 periods at 8% for the present value of $1. Excuse me, 8 periods at 5% or 0.67684. And then I come over here to the present value of an annuity of $1, 8 periods at 5%. And this is going to be 6.46321. Okay. So the cash proceeds as a result of the bond issuance is going to be the principal and then the interest. My total proceeds should be greater than 400,000. In fact, it's 425,000. So my premium on bonds payable is going to be 25,853. Okay. So let's now take what we've done over here and let's go ahead and prepare an amortization table. So my carrying value at the very beginning, and for this one, I do want to go through and use T accounts. I have bonds payable, 400,000. And then I'm going to have a premium on bonds payable. My premium on bonds payable is going to be 25,853. So my carrying value of my bond is going to be 425,853. What I then do is my interest rate, my market interest rate is at 5% or half of the 10%. So my interest expense is going to be 425,853 at 5%. And my interest payment is going to be 24,000. So my premium amortization is going to be 2707. Remember, when I'm doing the premium amortization, I need to reduce the carrying value down to 400,000. So my ending carrying value is I'm going to take my beginning carrying value, subtract the premium amortization, and I'm going to get 426, 423, 146. Okay. So right over here, my ending becomes my beginning. My interest rate is not going to change throughout the entire time. Interest expense right over here. My cash paid for interest is always going to be 24,000. Again, I'm doing this to make sure that our ending carrying value gets down to 0. My premium amortization right over here. And when I do the ending carrying value, I get down to 400,000. So this miraculously worked right on the money. So this is what I'm going through and going to do. Now let's go ahead and take a look at this second part right over here. So we redeemed the bonds on October 1st, 2021. So what I'm going to do for this is let's go ahead and just record the bond entries for 2020. So what does 2020 look like? So, oh, wow, this is going to be good stuff. So on 12/1/20, when I pay interest right, on my bonds. I'm going to be crediting cash for 24,000. I'm going to debit interest expense. My interest expense is going to be debited for 21,293. And then I'm going to debit premium on bond payable for the difference over here, or 2707. Okay. So that's going to be the amount of the interest expense for 12/31/21. So the company here has a bonds pay interest due date. Okay, so right over here. So if they have a year end, okay, so this is good stuff. So if their year end is 12/31/20, what we're going to have to go through and do is accrue interest for the 1 month. So here I'm going to have interest expense. Then I'm going to have premium on bond payable. And I'm going to credit interest payable. So my interest expense is going to be the 21,157 of the following year. I'm going to multiply that by 1/6. Okay, my premium on bonds payable is going to be 2843 times 1/6. So my interest payable is going to be 4,000. Does that make sense? Well, it's going to be 24,000, which is my cash paid for interest times 1/6. So we've done that part correct. Okay, now on 6/1/21, we've now gone through and we're going to make our payment. So what happens here? I've got interest payable is going to be 4,000. My interest expense is going to be 21,157 times 5/6. My premium on bonds payable is going to be 2843 times 5/6. Okay, so this is 21,157 times 5/6. Why is it 5/6? Because I've already gone through and recognized the interest, or the sixth of interest on 12/31/20. This is going to be the premium. This is going to be 2843 times 5/6. And I'm going to be crediting cash over here for 4,000, excuse me, for 24,000. Okay, so right over here, my debits equal my credits. Remember, I'm always making the cash payment here, and I'm making the catch up on the interest payable. Wow, that was exciting. Okay, so here's the kicker. Okay, the bonds yield on October 1st, I'm buying them back for 120. Okay, so before I buy them back, what I want to do is I want to show where is my premium prior to the buyback. So if we come over here and I look at the premium, this is 2707, 474, 2369. Okay, so that's how much I've amortized my premium by. Okay, so, and you'll see why I do this momentarily. So my unamortized premium is going to be 20,303. All right, so we're redeeming bonds. Okay, so this is my balance of my premium as of 6/1/21. What I want to do now, so as I'm looking at this, to make my life a little bit easier for the bond redemption, what I want to go through and do is I'm going to break up this bond payable into 2 parts. I'm redeeming 120,000 of the $400,000 of bonds. So as a percentage, I'm redeeming 30% of my bonds payable. So if this was my balance on 6/1/21, what I'm going to do is I'm going to split this up. I'm going to say bonds payable unredeemed or redeemed. And this is going to be 120,000. And this is going to be on 6/1/21. I'm then going to show bonds payable unredeemed. And this is going to be 70% of the balance, or 280,000. All I've done is I'm basically now bifurcating my bonds into redeemed and unredeemed. Okay, my premium on bonds payable, I'm going to do the same thing. So for my premium on bonds payable redeemed, this is going to be on 6/1/21. This is going to be 30% of 20,303, or 20,000, right? 20,303. And my premium on bonds payable unredeemed is going to be 20,303 times 70%. So this is going to be 70% times 20,303. And just to make sure that all these add up, perfect. Okay. So I've done this very intentionally because if you've watched my problem 14.2 video, this is my first try going through and doing it this way. It's probably going to be different than the book. So, but let's go through and have some fun with this. So the bonds pay interest on December. The due date of the bonds is June 1st. The bonds yield 10%. On October 1st, 2021, we buy back 120,000 of bonds for 126. Okay. So what we're going to do is we're going to first figure out how much interest did we go through and pay. And we are redeeming these bonds on 10/1/21. So for the redeemed bonds, my first step is going to be to figure out, well, what was the entry that I made for the interest expense as it relates to these bonds through this date. So when I pay for interest, right, I'm going to credit cash, I'm going to debit interest expense, I'm going to debit premium on my bond payable. Okay, so right over here, what I'm going to go through and do is I'm going to say, all right, how much cash should I pay out? Well, I know that I paid out 126,000, but that includes accrued interest. So how much was my accrued interest? Well, for these bonds, right, basically 6 months of interest is going to be my face value of 120,000. I had my interest rate stated is at 12%. So my annual interest is going to be at 14,400. However, according basically here, my semi-annual interest is going to be this times 0.5, or 7,200. Okay, so again, whenever I see an interest rate, it's always an annual rate. These bonds had a stated interest rate of 12%. Right over here, that was the stated interest rate. So stated interest rate, my annual interest, so my semi-annual interest is 7,200. However, I'm buying this back on October 1st, right? So I've got June, or basically from June 1st. So I've got June, July, August, September. So, and if I think about it, my next interest payment would be on December 1st, right? So I would have 2 more months left. So I'm going to multiply this value here by 4/6, right? You could also maybe even just skip this step over here. I've got 4 months. That's my annual amount. I've got over here, if I multiply this by 4/12, I get 4,800. Okay, so that's going to be the amount of cash that I'm going to be going through and paying out. Okay, so the cash I pay out is 4,800. The other way I could have gotten to this is I could have also said my semi-annual interest would be 14,400 times 0.5. Over here, if I multiply this by 4/6, for June, July, August, and September, I'm going to get the same amount. So I'm paying out cash of 4,800. Okay, so what is my interest expense going to be? Well, my interest expense is going to be 120,000. That's basically going to be my carrying value. My carrying value on 6/1/21 was how much for these bonds? It's going to be 120 plus 6,091, or 126,091. Okay, so my interest rate is going to be my market rate of interest. So again, we'll just go ahead and use the semi-annual market rate of 5%, or half of the 10%. So my interest rate, 6 months of interest, is going to be at 6,305. But I'm not using the money for the entire time. Rather, it's going to be for June, July, August, and September. So I'm going to multiply this value here by 4/6. So my interest expense is going to be 6,305 times 4/6, or 4,203. Okay. Wow, this is crazy. All right, but it's fun. I love it. Okay, so right over here, my discount, my amortization, excuse me, my premium is going to be $597. Okay, and this becomes extremely important for our next step, which is the actual bond redemption. Okay, so I'm going to be coming over here on 10/1/21. Okay, so over here on 10/1/21, I am debiting my premium on bond payable for $597. So I'm ready to go through and redeem my bond. I've gone through and I paid the interest through that date. So my premium on bond payable, the redeemed one, has a balance of $5,494. Now on 10/1/21, how do I figure this out? Well, I know I'm going to be debiting bonds payable for $120,000. I know I'm going to be crediting premium on bonds payable for the redeemed amount is going to be $5,494. I have to zero these out. Now, the fun part becomes is that how much cash did I receive? Well, I got 126,000, or how much cash did I pay out? So I paid out cash of 126,000. But this included accrued interest. The amount I paid for the accrued interest was 4,800. So the actual amount of cash paid for the bond redemption is going to be 121,200. So given over here, I have total debits of 125,494. I have total credits of 121,200. In order to make this balance, I need a credit of 4294. If you've watched my prior videos, when I sell an asset, if I have a gain, if I have a credit balance to if I need a credit to balance, I'm going to have a gain on bond redemption for 4294. Wow. Okay, my evil Zerg laugh. I'm not even sure if that's Zerg anymore. I don't know who that is. Okay, so that's what I have to, right? So that's what I have to do for that bond redemption. And I don't even think we're done with this question yet. That's so amazing. Okay, so I've done the bond redemption. I bought back 120,000 for 126, but I'm being asked to give entries through December 1st, 2022. Okay, so now that I've gone through and I've dealt with that part over here, what I'm now ready to go through and do is to deal with my unredeemed bonds. So for my unredeemed bonds, I'm now going to go, we're asked to do this through 12/31/22. So on 12/1/21, right, I have to go through and record interest. Okay, so my cash paid for interest is going to be 24,000, which is my semi-annual interest payment times 70%, or 16,800. The other way of doing it, my face value is 280,000. My interest rate is at 12%. So my semi-annual interest on this bond is basically going to be this at half, or 16,800. So that's where that number is coming from. What we can do now, though, to make our lives a little bit easier and is to kind of go through and check our work, is let's just pretend going down here. Okay. So what we're effectively doing is we're saying that our carrying value on the unredeemed bonds is going to be $294,212, and that's as of 6/1/2021. What is that? That's going to be 6/1/21. And our interest payment is no longer going to be 24,000. In fact, our interest payment is going to be 16,800. And let's see what's happening here. Okay, so my present value of my unredeemed. Okay. And there's something still wrong here. Just give me a moment. Okay, so then again, to go through and to check my work, and this is where I kind of got screwed up, is that right over here, is that if we took 70% of the bond value right up here, and we made a separate amortization table, this is what it would go through and look like. So over here on 12/1/21, I just got thrown off by a year. Over here, we've got the amount of the interest expense. And this is for the unredeemed bond. It's going to be 14,711. And then my premium amortization is going to be 2,089. Then on 12/31/21, what I'm going to have to go through and do is I'm going to have interest expense, premium on bond payable, interest payable. And so this is going to be on, I'm going to go to 6/1/22. My interest expense is going to be times 1/6 because it's just for the month of December, or the time between when I last paid for it. So that's going to be 14,711 times, or excuse me, 14,606 times 1/6, or 2434. I'm just going to move this down a little bit. Okay, so this is interest of 147,14606 on 6/1/22 times 1/6. So the premium is going to be 2194 times 1/6, or 366. And then my interest payable is going to be 2,800, or 16,800 times 1/6. Okay. So when I get to, I'm asked to prepare journal entries through when? I'm asked to prepare journal entries for this through December 1st, 2022. Oh, lucky us. Okay. So the next one over here is I'm now going to go to 6/1/22. So I'm going to have a debit to interest payable, premium on bond payable, interest expense. So my interest payable is going to be 2,800. I'm paying out cash of 16,800 on 6/1/22. My premium on bond payable is now going to be, we're going to multiply both these values by 5/6. So this is going to be 14,606 times 5/6. This is going to be 2194 times 5/6. And we come up over here with 16,800 on both sides. Now I go to 12/1/22. This is going to be a little bit, hopefully a little bit more simple, which is I'm going to debit interest expense, debit premium on bonds payable, and credit cash. So my interest expense, my premium, and then my cash is going to be 16,800. And we're good to go. Okay, so when we go through, and again, as you're going through and doing this, right, the other way you could have done this probably a lot easier than myself creating a new present value table is that you could just have taken these amounts and multiply them through by 70%, and you would have gotten the same, you would have come up with the same result for this question. So let's just kind of do a recap. So we got the bond issuance. What was tricky about this question is a few different ones, is that you had the interest payments that were not lined up with year end. So you had to go through and accrue for the 1 month. And then you had the bond redemption. But notice over here, though, with the bond redemption, and this is my first view of, this is my first time making this video. And I did not look at the solution until I was well into it. Is that you got to split it up. You got to keep them separated, right? Yeah, keep them separated. Okay, so you got to keep them separated. I would do the redeemed and the unredeemed, because if you don't do it this way, so split them up, figure out the interest through the repayment date, and then go through over here, and then go ahead and then do the gain on the redemption, or gain or loss once you go through and redeem it. So this is considered to be one of the more complicated questions. And this goes back to actually somebody I was a teaching assistant for at UC Santa Barbara. When I talked to her before I was teaching intermediate accounting, I asked her, I said, hey, do I need to supplement what I'm teaching you? Because a lot of times in financial and managerial accounting, I find myself supplementing But basically what she said was, no, this book has enough. And she was absolutely right. This is a lot. So, but again, this is intermediate accounting. It's meant to be fun. And I want to thank Wiley for allowing me to use their questions and for allowing me to come up with these solutions. And if there's any other videos you would like, please feel free to ask for them in the comments. Have a great day.